This is Matthew Cratter from Trader University, and today I want to talk a little bit more about the bigger picture, what I think is going on with the Fed, with the crypto banks, and with Bitcoin. And I'm summarizing this, calling it Shut the Exits, Turn on the Money Printers. We've been saying for over a year that the Fed would continue to hike until they blew up something big, and that's how we would know that the Fed was done. And I think we're at that point now. I think the Fed is essentially done, apart from probably a small rate hike, as we're going to see next week. Basically, the Fed hiked as much as it could, trying to go after inflation that it itself caused by printing too much money, and it caused a bank run in the process, raising interest rates as high as it did. The other thing I kept saying is that when the Fed is done, we're going to know it because we're going to see Bitcoin really pump hard off the bottom. And that's what we've been seeing over the past 3 days. So we have these confluence of factors. We have the banking system, the bank run in the US, and now we have Bitcoin pumping really hard. Now, the Fed was still very hawkish as of even a week ago. We had Powell's testimony before Congress, and everyone was saying, well, now he's going to hike, instead of hiking just 25 basis points at the March meeting, he's going to hike 50 basis points. But how quickly things reversed. What happened after that? The CEO of Silicon Valley Bank, presumably, as he said, saw this hawkish Fed that was going to stay higher for longer, keep interest rates higher for longer, and realized that it would blow an even bigger hole on the asset side of that bank's balance sheet. So the CEO tried to raise cash by dumping bonds at a loss and also issuing some new shares, basically started a bank run on his bank and on a series of other smaller, medium, and small regional banks, as everyone else realized how the other banks had serious mark-to-market losses on their bond portfolio as well. And these losses were caused by the Fed raising interest rates. When interest rates go up, bond prices go down. As this bank run took hold, traders began to bet over the past few days that the Fed hiking was almost done. And here's the thing about it. As interest rates move, as these various markets move, this is a de facto loosening of monetary conditions. The Fed doesn't actually have to do it. What is happening and what we're seeing is we're seeing future Fed policy get priced in to the market today. So for example, if we want to take a look at Fed funds futures for the end of 2023, this is the Z, which stands for December, Z 2023 contract. As of just a week ago when Powell was so hawkish, this was trading close to 5.6, call it 5.58, and it's since come off quite a bit. It's bouncing back a little bit as we got a slightly stronger CPI number than the market wanted to see, but we can see here that it's still down almost a full percentage point from over just the past week, which is a gigantic move for a market like this. You can see how it doesn't really move that much most of the time. Also, if we look at December of 2024, we can see that that has also moved sharply down. And it's currently at a 4.2%, which is actually below where the Fed is now. So this is pricing in rate cuts as well. Now, the CPI, as we said, came in a little bit stronger. It still came in down, but the month over month was a little bit stronger, it looks like at first glance. So what does that do to Fed funds? Basically now the current target rate for Fed funds is 4.5% to 4.75%. That's where we are right now. We have a March meeting coming on March 22nd, and there's now just an 8.5% chance that they will not hike at all. And there's basically a 90% chance, 91% chance that they will hike 25 basis points. We can see here this goes up 4.75% to 5%. Now, what does this mean in terms of where the Fed is? It means they're very, very tight. As we said, once the Fed gets above the 2-year note, this is a sign usually that it's done. And we've been talking about this for a while. So even where the Fed is now at 4.5 to 4.75%, let's take a look at where the 2-year note is. The 2-year note has come down sharply over the past week or so. So if the 2-year note were still up here around 5%, we would say that the Fed was not done. But now the Fed funds is going to be trading, even where it is now, is trading above where the 2-year note is. And you can think of the 2-year note as a sort of mathematical calculation that takes into account various holding periods. So for example, you could hold a series of 3-month T-bills, or you could hold 4 6-month T-bills. And through the magic of math, interest rate math, you can come up with where the 2-year note should be based on where everything else should be. So this is a sign that the Fed is already too tight. It looks like the market's basically betting that they have to do what they said and raise rates a little bit, but it's certainly not going to be 50 basis points as it was a week ago. It's just going to be 25 basis points. and then the markets begin to price in actually some Fed futures, Fed funds cuts. As we said, we've been seeing this as well, where the dollar index, the Dixie, has reversed. This is the 50-day moving average. The blue line, the 200-day moving average, is the red line. And we can see that the dollar had a very strong bull market as the Fed was hiking more aggressively than other central banks. If your currency has stronger, higher interest rates, it will usually appreciate versus other currencies. And so this was the US dollar appreciating against a basket of other currencies, mainly just the euro and the yen. And now we've had a moving average crossover, a death cross in this, which suggests that US dollar strength is over. And it suggests that the currency markets, the FX markets, are projecting a weaker Fed as well. So we're seeing this confluence of events. If you want to just look at one thing, you can look at the price of Bitcoin. That tells you everything you need to know about the coming liquidity conditions. So that's the Fed side of things. Basically, I would go out on a limb here and say the Fed is done hiking. We get that one 25 basis point hike in a week from now, but they're basically done. So knowing that they're done, what is happening on the Bitcoin and crypto side of things? Basically, we've had 3 crypto banks. Silicon Valley Bank, which was closed by regulators on Friday, certainly serviced a lot of crypto startups, but the really 2 big ones for servicing crypto and Bitcoin companies were Signature and Silvergate. Silvergate announced that they were winding down on March 8th, and this was a huge bank going away. And then what happened on Sunday is the regulators shut down Signature Bank, and they're trying to pin the blame for this on here's a typical bad Bloomberg article blaming us, basically saying the lender, the Signature Bank, survived blowups with cabbies, bad landlords, and Trump, but crypto took it down. What actually happened, it would appear, is that this bank was actually not in that bad a condition, and they were closed on the pretense of there being a potential bank run. This is what Barney Frank, who's on the board, I believe he's on the board at Signature, came out and said on CNBC yesterday. So this is something to consider. It's just very strange seeing 3 crypto-friendly banks close in the same week. People like Nick Carter are calling this Operation Choke Point. I believe it is 2.0. And so one hypothesis here would be, and then there's this Warren Togami tweet, Operation Choke Point 2.0. Today I heard this from the management of a small U.S. bank. Basically, every bank regulator is calling every bank, asking for the liquidity report, asking whether they have any exposure to crypto. And again, government regulators, apart from perhaps Gary Gensler, don't really understand the difference between Bitcoin and crypto. Bitcoin is a completely different safe asset compared to crypto, but for the purposes of this, they're being grouped together. And so there's a lot of pressure on banks from the regulators not to service crypto companies. This is what the choke point refers to. And so what I would suggest is that Fed and Treasury are trying to close the exit ramps. In other words, the banks that service Bitcoin and crypto companies. Be a little hard to just close Coinbase and Kraken and Gemini at this point, to just completely shut them down. They would have a problem in the courts, but what they can do is try to attack the ramps, the banking ramps, the on-ramps and off-ramps as best they can before turning the money printers back on. And it looks like the money printers are definitely being turned back on as we speak, especially with the Fed essentially guaranteeing U.S. banking deposits. If anything goes wrong, the banks can just take the asset side of their balance sheet, even if those assets have fallen sharply, and give them to the Fed and get cash at par to bail out the depositors. So basically, it looks like one way of looking at this is the Fed has taken on responsibility for the entire U.S. banking system and deposits on that, and they're the ultimate put on the banking system. So this is, you can imagine this going on in the government's head or certain regulators' heads. Okay, guys, let's blow up crypto and close the crypto banks. Okay, there we did it. We got Silvergate closed. We have Signature closed. We have Silicon Valley Bank closed. Bitcoin must be dead now. So let's go take a look, see how Bitcoin's doing. Meanwhile, Bitcoin in just 3 days goes from 20,000 to above 26,000. So what I would say is that Bitcoin is back. The bull market in Bitcoin is back, and the Fed is done. Imagine being a government regulator thinking you've just killed Bitcoin and then seeing a chart like this right as the money printers are about to get turned back on. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.